The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Hey, Jeremy. Good to have you back. It's, Thursday the 27th. How's your week been?
Hi, Gareth. Yeah, been quite busy, but it doesn't feel like there's a lot new to talk about.
Maybe not on the macro level, but a bit of politics bouncing around and lots of company news, more sort of small mid-cap UK news that we can chat about in a minute.
Quite a lot of corporate stuff going on.
Yeah, bit of news flow. But so what has caught your eye on the macro or the economic stage, trying to avoid too much politics if we can?
Well, yeah, politics is continued to dominate domestic and international headlines, unsurprisingly. Most recently, like overnight, including the tragic events in Kenya.
Yeah.
And I guess it's not surprising how difficult it is to keep up with all these political events and elections, given that there are, I think it's 63 or 64 elections taking place this year. It's more than one
Globally,
a week.
yeah.
So for the UK, the election has become more interesting with the impact of reform, particularly on the fortunes of the Conservatives.
Yeah, for sure.
If they need any help in committing political suicide, but they've got all the assistance they need now. So, as we said before, the outcome next week is pretty clear in terms of who is going to be the next Prime Minister. So there's a lot of chopping around in politics. We've got the French elections taking place this coming weekend and the following weekend. So they'll actually start their electoral process before we do, so they're not messing about. But there's lots of political uncertainty around, and that has been translating itself, as we've talked about before, into currency volatility. And this week, I think the main sort of global macro factor that markets have had to conjure with is a return of Asian currency volatility, also known as yen weakness. And this is on the back of continually strong dollar and a US dollar yen rate that's now moved above the 160 level for the first time since the early 1990s. And looking at a piece in Bloomberg this morning, in terms of the major currencies in the world, the yen is weakened to the extent of 15% year to date. The pound sterling is barely changed year to date. So I think that is an interesting factor, but we tend to not really focus much on what's going on in Japan, but their bond yields are rising, but still very low by comparison to any other Western financial market. The Japanese government 10-year bonds are trading back to recent highs, but they're still at or just above 1%. So they're very low. And therein is the problem, because we're now in the territory where one would expect, well, the Bank of Japan has previously intervened to support its currency. There's no sign of that happening this time. But a few months ago, they were rumoured to have employed something like $60 billion worth of FX reserves to defend the currency for a matter of a few weeks. So this is a very expensive exercise. And the Bank of Japan and policymakers in Japan must be running out of patience, and they're certainly running out of time for the Fed to lower its rates, which it's showing no signs of doing right now.
And you've been highlighting this for a while. So the risk, as I understand it, is that rates get raised in Japan or the Japanese government sells dollars to bolster the yen, and that puts up the cost of borrowing for the US. Is that right?
Yeah, if rates go up in Japan, there are two things that happen. One is that Japanese investors and international investors who are engaged in what is known as the carry trade will look to repatriate capital to Japanese assets at the margin. And this runs the risk of destabilizing other sovereign bond markets, particularly the US bond market, which is the biggest bond market in the world and the reference bond market that other financial assets are priced off. So This is a very delicate situation.
Yeah.
The other reality of Japanese interest rates going up is that the Bank of Japan is very heavily indebted, and it very soon reaches a point where all its tax revenues will be going on debt servicing costs.
Right. So if interest rates do go up, they're going to have a problem in terms of their own solvency or their ability to pay their interest bills. And if they don't go up, then the yen might continue to decline.
Yes. And we're in a world where within the last couple of weeks, estimates of the US federal deficit have gone up by over 25% from 1.5 trillion to 1.9 trillion.
Yeah.
There are people like Mike Howell at Cross Border Capital, who monitors these things very closely, holding out Japan's plight and the yen's weakness as a path that other economies are destined to follow. And it sort of echoes this dollar milkshake theory that ultimately for countries other than the US, there are very few realistic long-term alternatives than issuing more debt by ultimately printing money.
Yeah.
And this is monetary inflation writ large. And unsurprisingly is leading to this yen weakness. So they really are caught between a rock and a hard place here, as the Americans would say.
Okay. Well, as I said, you've been highlighting it for a while, and it feels like it's beginning to become more and more important as the months go by. So, yeah, we'll keep a close eye on that. What else has been going on?
I mean, that's really it. We've had a bit of wobbly news coming out of the commercial real estate market where some AAA-rated bonds have been wiped out. And this is the first time that's happened since the global financial crisis. And we've had US first quarter GDP data this week, which were revised up from 1.3% to 1.4%. So confirming the big slowdown from second half of last year, but stronger than first estimated. So probably not great news for the Fed in their ambitions to want to reduce rates later this year. So yeah, I think that's probably about it on the macro level. But there's been quite a lot going on in the UK this week.
Yeah, there has. So from the progressive client standpoint, we had a few companies reporting. We had an inline AGM update from Vertu Motors, one of the UK's larger car retail groups and car maintenance organisations. We also had some positive FY24 results from IG Design and from Gear for Music, both of whom are going through quite significant changes in their own businesses. IG Design is a greetings and packaging business. Gear for Music is online retail of musical instruments mainly.
Yeah.
And they've both had some difficult times, and that they're both working through sort of changes or recoveries, and they both seem to be doing pretty well in that regard. A slightly more cautious tone from Sanderson Design Group. They had an update this morning actually highlighting some pressures in areas of the UK market, which seem to be affecting them a bit more than the market had expected, and that their shares are down, give or take 20% today. So that hasn't been particularly well received, but it feels like there are issues that they can deal with and again try and move through from the sort of the difficult situation they've been in recently. So hopefully signs of some kind of recovery there down the track. But there has been a lot of other corporate news, lots of updates, trading updates and results reported. And I think you were looking at some other companies in terms of sort of the general view on consumer sentiment.
That's right. Along with the names you've just mentioned, which are all have businesses that are faced directly to the consumer and predominantly the UK consumer, although in the case of Sanderson, I think they do a lot of business in the US, which is part of their business that they're saying doing very well. We've also had trading updates or results from people like Watches of Switzerland, who are saying very much the same sort of thing that Sanderson Design was saying. Their US business, their rest of world business, which is the smaller part of their business, has been doing pretty well. But the UK has been underperforming for some time. Now, they've been pretty effective at communicating that. Their share price has been weak, but they're now saying they're starting to see signs of stabilization in their UK business, and that they see these pressures that have been on their business easing for the current financial year. So they're very confident they've been gaining market share in the UK and in other markets, but the UK market has been tough. Other consumer-facing, predominantly UK businesses have been people like AO World and Marks Electrical, which are both consumer discretionary white goods and household appliance retailers, online businesses. They both had updates this week. Again, they seem to be coming through with better results, typically on not higher revenues or volumes, but lower costs, more efficient operating models, higher levels of profitability. And both them and Halfords today people like Revolution Beauty and Warpaint, the beauty and makeup specialists, actually talking, I would say, in the main, a pretty positive outlook for the UK consumer, with inflation broadly under control. There are several references to increased supply chain costs, such as freight and container costs. And one or two people, I think it was Halfords particularly, mentioning the 10% increase in the national minimum wage, which is a headwind for them, but possibly a tailwind for someone like Warpaint London, who's selling low-cost makeup. So broadly, I think this feature that the UK consumer is marginally in a better place, and that we've got the preconditions, at least, for a stronger second half. So there's a lot resting on the second half for some of these companies. There's a high propensity for these companies to say our results are going to be more second half weighted than normal. But there's a strong theme from what these companies are saying right now.
Yeah, there is. I mean, it certainly seems that the companies who've spotted the issues early, or they've experienced them early, they've been able to set their sales correctly for the prevailing market conditions, and they're starting to do okay. And yeah, sure, there's various different phasing or timings of these depending on which markets you're dealing with. But I think there is a real theme that companies who've been through the challenges are beginning to work through. Some of them, perhaps Sanderson, are now experiencing challenges that haven't before, but they should be able to do the same and structure themselves correctly for the business they've got. And in Sanderson's case, I think you're right, that their big opportunity remains in the US, which is their big focus. So there should be good potential for them down the track there. But overall, yeah, it's starting to feel like that consumer optimism is beginning to show through. As long as the politics doesn't derail it in the next fortnight, then hopefully there'll be more to go for H2, as you say. And what about next week? Anything other than the election to look forward to?
Right. Yeah, we've got a general election. I think it's Thursday, isn't it? It usually is. I guess we'll know who our next Prime Minister is on Friday. And we'll be no doubt hearing how the bookies are settling all those bets with various MPs and so on. But yeah, before that, of course, we've got the first round of the French general election this weekend. So they're getting out and voting before we even get around to doing it. They have a two-stage process, and the second part is the following Sunday. But on the economic front, we have Eurozone inflation data on Tuesday, and on Wednesday we get the minutes to the last Fed meeting. I don't think there's going to be any big surprises in either of those, but it's also Jobs Week next week in the US. So we get the JOLTS report on Wednesday and the non-farm payrolls on Friday. And like we have for about the last 100th time in a row, the market is looking for a substantial fall from the last month's number. And each month it seems to be surprisingly strong. So let's see. But the expectation is that on non-farm payrolls, the increase in payrolls goes from last month's 272,000 down to 180,000. But I think, as with previous weeks, probably the politics is going to continue to eclipse the economics for a little while longer.
Yeah, it feels that way. And obviously, the first round of the French elections this weekend, we might start to see early signs of whether or not we're getting that lurch to the right, which Macron's trying to either head off or at least to smoke out. So, be interesting to see whether that...
I think on that point, it's interesting. I've heard people who follow these things say that the French bond premium to the German bond yields is indicating that they believe a hung parliament, which I think would probably right now be taken by Macron as a victory.
Okay.
Clearly not a decisive one, but yeah.
At least that'll be something. So, we'll wait and see for that. Good. Okay. Brilliant. Right. Thanks again. Good to catch up, and we'll chat this time next week.
Okay.
Talk to you then. Thanks.
Bye.
Brought to you by Progressive Equity.